Hello, everybody. This is Axel Merk, the President and Chief Investment Officer of Merk Investments. With today's chart book, we are focusing on the U.S. business cycle today. As a reminder, Nick Rees, our Senior Financial Analyst, is the driving force behind these chart books. When you see commentaries in blue in the bottom, those are Nick's commentaries. He tries to stick to the facts and give a tiny bit of his interpretation. My role is to give a whole bunch of my interpretation, meaning I look at this is an opportunity to communicate with you, with our audience, and discuss the business cycle. But I will be far more flexible, let's just put it this way, in over-interpreting what's in a chart. Nick gives his own analysis, a cut-and-dry analysis of what these charts show. I'd like to encourage everybody to watch his video analysis of this as well. Several things have happened of late, most notably, as you are aware, the equity markets have had a bit of a tantrum of late, not too severe, but a little bit on the backdrop of rising rates. So some of the things we have been talking about higher rates are coming to fruition. And the question is, well, what are the implications? And the one thing to be aware of is we always try to give more emphasis to the most recent news events. And is that warranted? Is it not warranted? And it's one of the reasons why Nick is trying to be as dry as possible. I can be more subject to the quote-unquote jumping the gun sort of theory. But then again, I see my role very much into answering this question: why is the business cycle important? We do with this chart book and many of these other chart books to make investment decisions. And in making investment decisions, my key role, I believe, is in assessing different risk scenarios. What is the risk of certain things happening? And we can just take a position, hey, we just hold equities forever, everything is going to be great. Or maybe we should think about, well, maybe we're overexposed to equities and maybe we don't want to have an equity portfolio that could go down 20%, 30% or more if there were a bear market. And as time has evolved in this bull market, we've now had a bull market since 2009. That means if you haven't rebalanced, the risk portion of your portfolio is significantly higher. That means in the fixed income side, or it doesn't necessarily mean it, but many people on the fixed income side have been looking to increase their yield by going out on the credit curve, possibly on the duration curve, meaning that their fixed income portfolio might not be all that much have these characteristics of a traditional fixed income portfolio, but might be much more correlated with the risk assets if there were to be a downturn. And so, yes, this chart here shows that historically speaking, bear markets tend to happen mostly during recessions, with the very important difference here of the 1987 stock market crash that we had. Here we go. There is, if you can see my cursor. There was no recession here. And of course, the folks who say, oh, why worry about something like the 87 crash? If you just held on to it, everything would have been fine. Well, I tell you, if you've been around in 87, it certainly didn't feel like it. And so, and the reason why it is one thing to have the theory and another the practice, veterans of the markets will appreciate that because they do tend to humble you. There's the time to prepare for these sort of extraordinary events is before they happen. If you rebalanced ahead of the crash, sure, the 87 crash was painful, but you would have been all right. Whereas if you don't rebalance, what happens is you're overexposed to risk assets in your portfolio, and then you plunge, which means you lose much, much more, not only than you expected, but than you signed up for. When you initially set up your goals, your investment goals, everybody always asks, what's your risk tolerance? It's a number on a screen or this and that, and you have no idea really what it means. But let's just assume that you did the right thing and specified your risk profile differently. Well, in an extended bull market, the risk portion of your portfolio increases, which means you're going to be more subject to the sensitivities of the markets, and it is going to be all the more gut-wrenching. And that is why people then sell out at the bottom, is because they haven't done the right thing and rebalance. That is the key reason. Any case, going to the business cycle, so obviously we have a Goldilocks economy of sorts, at least. Fed Chair Powell was asked, is it too good to be true? Leading economic indicators are doing just fine, not just fine, they're doing very, very well. And the one quote-unquote warning sign we had was the steepness of the yield curve. The steep curve of the yield curve refers to the relationship between the shorter term and the longer term yields. And there has been this fear that short-term rates will be higher than long-term rates. Well, what's been happening of late, the long end of the yield curve has been selling off. And so the yield curve is actually a tad less steep right now. And of course, we never know whether that sell-off is going to continue. But one of the reasons why the yield curve doesn't automatically invert just because you raise rates is because here in this case, we're comparing the 3-year yield. We already have rate hikes priced in the 3-year yield. So sometimes it's the 2-year, sometimes the 3-year yield versus then the 10-year, sometimes versus the 30-year yield. But these are all different metrics of the steepness. Historically speaking, an inversion of the yield curve has preceded a recession, but there are some false signals in that. And I like to reemphasize what I've mentioned on these videos before. It is not the job of the Federal Reserve to prevent the yield curve from inverting. They have plenty of mandates. This is not one of them. And the reason why the Fed would induce a inverted yield curve, meaning short-term rates and higher than long-term rates, is because they need to take the foot off the accelerator and apply the brakes, because inflationary pressures are increasing or some other events are happening that leads them to do that. And so the yield curve steepness is, of course, a good cross-check as to where we are in the economic cycle. But very much so, it is not that the Fed will just have to stop raising rates because we are going to have a yield curve inversion. US purchasing manager indices are doing great in many ways. The reason why I'm jumping ahead here is because there are some clouds on the horizon. If you look at the global purchasing manager indices, and by the way, you can download the PDFs here as well at merkresearch.com or merkinvestments.com/research. You can get these the PDF if you want to look at it in more detail, and the video quality isn't good enough here. Look at the blue line here. This one here, that is Germany. And I've been following that for an extended period, and it is a bit concerning. Now, keep in mind, all the readings above 50 signal economic expansion. But every week or so, some economic numbers have been, on the forecasting side, have been downgraded in Germany. And I've been trying to wrap my head around it. Is it the fear of a trade war? Or is it an actual slowdown? Or is it that the German economy is breaking at the seams and they cannot find enough workers to do the sort of expansion that they want to do? Now, the PMIs, unlike some other metrics, tend to be less based on opinions. There are several metrics out that indicate more the fear of a trade war. And those have clearly been negative, and then the Germans and the Europeans in general have been surprised that things aren't so bad. But the PMI is supposed to measure what people actually do a little bit more. And to me, it's a mixed bag of the different types of interpretations. And part of the reason I'm hesitant is I do scan news around the world, and especially in Europe, go into quite a bit in depth as to what's happening. I don't see Germany being slow, but I do see a very tight labor market. I do see interest rates that are way too low for Germany. And so the question is, well, what's going to happen? By the way, incidentally, if you look at the orangey line, that's Italy. Italy has been, of course, in the news quite extensively just on that note, we just published a Merk Insight, merkinvestments.com/insights. You can get our assessment of what we think is the right medicine for Italy. But Italy seems to be doing just fine. The one thing that's not so fine is where this new government wants to be heading in with some expenses they want to put into the system, bake into the system by providing basic income and the like. And so part of that is regular politics. A lot of the, and by the way, they're not trying to blow out the deficit, but They have some back and forth with the European Union, and obviously they're violating the rule that if you have a lot of debt, you've got to have a tighter purse, and the new government in Italy doesn't really want to pursue that. Now, back though to the PMIs here. What I'm trying to figure out is, in the business cycle, we've seen a hiccup in emerging markets, and we see global PMIs coming down. Are we at the stage where we are so far into the economic cycle that we're going to soon have a downturn? So heading here to the unemployment at 3.7%. Now, to me, that is at the very least a yellow light flashing. Clearly, when you look at these unemployment numbers, it talks about the willing workers, like if who are looking for a job, and people have been coming in from the sidelines who weren't previously looking for the job. So how far can you take this down? This chart here only goes back to 94. This is the lowest rates since the late 60s, and to me, this is a clear sign that this economy is at risk of overheating. There's another model of unemployment. Several indications here that we might be operating above capacity. This is based on an estimate by the Congressional Budget Office. Now, these are just estimates by human beings, and so this is mostly seen as a relative trend. I'm not so sure whether I'd overinterpret whether we are kind of here at this very precise level and overcapacity or not. It's just a metric that certainly things are doing fine. And the same thing here with the so-called output gap. This is just a measure by economists at the Congressional Budget Office. More relevant, I believe, is the Atlanta Fed GDP Now indicator. This is a forecast of where GDP is going to be, and while the forecast is volatile, they've been pretty accurate. And so they're obviously saying we're continuing nicely on the growth. The question is, are we on the so-called sugar high? Is it sustainable? What I do know is that we've clearly had a significant boost in earnings. We've clearly had a significant boost in growth because of the stimulus. And while I do think that some of those changes that have been introduced also on the structural side, meaning on the regulatory side, provide a more structural boost, and it is still on a relative basis, are things as good as they will be, and with an eye on obviously on the stock market. Now, here an important one, a lot of people talk about consumers. The credit cycle seems to be doing just fine, meaning that the number of delinquent households is very low. Obviously, rates have been rising. We don't see any stress here yet. We have this moving average here as well. That's depicted, or two moving averages actually. But so that the line isn't so volatile, and so this doesn't signal a turn in the credit cycle yet. And by the way, as people come in from the sidelines, to the extent that they do, they can obviously do more spending. And so all of this is good for economic growth. The question is how much is priced into the markets and so forth. Now here is the one line that I do get concerned about, and it is one of the reasons why I am, quote unquote, jumping the gun here a little bit on getting a tad more pessimistic on risk assets. This is consumer confidence. We are at highs that are stunningly high. We got unemployment at amazing lows. We got consumer confidence at amazing highs. To me, these are the screaming warning signs of an economy that is at risk of overheating. And this is also a screaming warning sign of, wait a second, are things a little bit too good to be true just when we think everything is great? Shouldn't we check chips off the table? And by the way, some dominoes around the world are falling, meaning emerging markets show some stress. Now, note, we haven't seen that stress domestically, at least not to a significant extent. Most notably, we haven't seen it in the high yield markets. Lending standards for the banks, banks are lending generously. Now, clearly they have enough money in the system to be able to do that. We did have Goldman Sachs take down the lending on some consumer product that they were working on, and so they are being a little bit cautionary. They, historically speaking, they tend to be more conservative than some others, so they seem to be saying, well, let's be a tad more careful. But if you take that more broadly, and by the way, it is not an investment recommendation on Goldman Sachs in any fashion, lending standards according to these kind of more general metrics here are clearly easy as can be. This is what I'm referring to. In the US, we don't see stress. The high yield sector is doing just fine. We did see some stress here. This was mostly fracking related. And one of the things, by the way, we have available these days, we have these premium chart books available that Nick is providing. And one of them is on oil as well. It's a worthy look to have at these premium charts as well. And the short of it is that the oil sector is more relevant for the US economy and than it has been in the past. And so as a result, it's one of the reasons why we should monitor that sort of thing. And so this is Nick's summary of what's happening. And he says in the short term, he's positive to low to medium uncertainty. And in the medium to longer term, he is neutral to negative. And the clear question is, well, what is that horizon? Well, up to 5 years. I would be very surprised if this economic expansion lasts 5 years. I happen to think what we're going to get is the classic way of an economic cycle gets shut off is with the Fed continuing to hike into an expansion because inflationary pressures are increasing. And just keep in mind how structurally the Fed is wired, right? They read the same news we do. They cook with salt. They are not some magicians. And so they know that inflation is all right. It's actually near target right now. But it's not been horribly bad. And one of the things Fed Chair Powell has been pointing out is that the Fed has a lot of credibility and inflation expectations are anchored. Well, what that means is they can afford for inflation to go up a little bit more than it should because the market will trust that the Fed will then do the right thing. And Powell has indicated, yes, he will darn sure make the right thing. It's one of the reasons, by the way, bonds have been selling off because he recently re-emphasized that. But if you turn that on its head as an investor, what that means as well is that they'll continue to be sluggish and slow in hiking rates and will actually allow inflationary pressures to increase. That means inflation will be a problem. I'm not suggesting we're going to have hyperinflation or anything like that, but inflation will be more than the target range, and then they'll have to continue tightening into that. And because Fed policy acts with a lag, unless they are going to be Greenspan-esque, that's referring to former Fed Chair Greenspan, who looked at the data and jumped the gun and did his thing because how he thought things would evolve. Now, a Powell Fed, if I read him correctly, will look at the data, and indeed he's more open about what type of data he looks at than his predecessors have been, and then act, which means he'll be slow, which means inflation will be an issue, and which means he will hike into that, which means we'll go up further than is currently priced in, which means we're going to then have an economic downturn. And so to me, that means several things. It means for us internally, we take positions on interest rates themselves. Reach out to us if you want to help us do that with you. But it also means that on the business cycle, it is really up to the investor to say, well, are we going to look for the peak in the cycle to take down our equity exposure? Do we take it down now, or do we not take it down at all, for example, right? I mean, historically, during recessions, the markets haven't done so well. But also keep in mind, we've had 9 years of economic expansions. We see certain areas in the risk assets to have some tremors. And so at the very least, I would encourage people to look at whether it's worthwhile to rebalance their portfolios. I tend to be more proactive. I tend to not want to squeeze out the last bit in a bull market. Now, one of the reasons, by the way, why investors tend to be most reluctant to take chips off the table is because they might have to pay taxes. And the good news about paying taxes is you actually have a gain. If you wait for the bear market to be there, you're not going to have a gain anymore potentially. Maybe this time around because market has been up so well. But that is one of the reasons why it's so important to have actually a process. So you have an investment process of what you're going to do throughout the cycle and be comfortable with that. just buying some quote-unquote protection here and there is probably not going to be cutting it. Sometimes when you buy protection, you just spend a lot of money buying that so-called insurance, and it would have been far easier to just take down the risk profile, aside from the fact that the quote-unquote insurance is probably not a perfect hedge either. I'm not going to go too much into the detail here as to what sort of things you could buy as insurance. Reach out to us if you want us to help you with some of the ideas on what to do with the portfolio, how to structure it, how to move forward. In any case, for the time being, give us feedback on these research reports. Would you like a different format? Would you like us to cover different topics? Again, this is my take on things. You can download the chart book at merkinvestments.com/research. You can get our premium chart book. You can get Nick's analysis, and obviously read our Merk Insights. And have a wonderful day. Talk to you next time.